It's a worrying look of people looking through the door and deciding do they like the look of us or not.
Yeah.
Oh, I've heard of all them before.
Am I going?
Oh, that I didn't think was the option. I thought it was Turkey or here. Are we in? No, we're not on yet. I haven't switched it on. Oh, we're doing okay. Yeah. That's good. It's interesting, it's a complete extraction. I'm suddenly looking at my pen and thinking, there's no rating agencies here at all.
No. Well, usually get a few.
You normally get the odd observer kind of coming in. Yeah.
It was interesting to see the hands being raised on the last one, of how many investors were, how many financiers.
Yeah.
It was what, four and a bit investors.
Yeah.
You know, it shows that
That's double the year before.
Exactly, but it shows that how concentrated that skill set is currently.
But it also shows that people want to do it on a plate. You know, for the broader community, they just want it delivered as a package. You know, they're not going to come to conferences in a big way. They just want to come
They don't have the resources.
They might go to one event a year.
Yeah.
Exactly.
The packaged project bond product.
I think it's going to be concentrated. I think it's going to be concentrated in the short term with the small group in the short term.
Okay, are we live? Are we good to go? Fantastic. Right, good afternoon, ladies and gentlemen. We are very pleased to see that there are more people in the audience than there are up here on the podium for this session, given the fact that the topic, you know, is something that, you know, I wish we could tell you. We were going to tell you something that you haven't heard in bits and bobs through the last couple of days and in various pieces, but we hope to put another slant on it and keep it interesting, as we're conscious we're the only thing sitting between you and the end of the conference. So I say thank you all for coming. Brief introductions. Iain Barbour from Trifinium. I look after our advisory businesses, particular focus on providing controlling creditor services, and we'll talk more as we go through, because it's something that we are currently doing and look forward to doing a lot more of, and it's been clearly a void that's been talked about. Ali.
Thank you, Iain. Ali Miraj, ING Syndicated Finance, covering infra and PF across the ME region.
Good afternoon. Stephen Mowll from HSBC. I work on the debt capital market side, focusing on the infrastructure sectors. So all kind of economic infrastructure, but as a part of that is project bonds, which we spent a lot of time over the last 5-6 years trying to develop. And hopefully we'll be getting there soon.
Well, good afternoon. Rutger Grotenhuis, working for RebelGroup, financial advisor for many of the Dutch contractor and some investors working on the Dutch PPP market. Was involved in several deals like A15 and recently the closing of the National Military Museum, but also was closely involved in developing a new funding structure, actually compliant with the new funding structure, with a direct investment of an institutional party involved. So that makes it interesting to be here as well.
Thank you. Hi, Alexis, Postel-Vinay. I look after the loan origination business for BNP Paribas in the Middle East, but for what's relevant today, I look after our syndicate function for infrastructure and project finance. We look after loan origination, distribution and pricing for project finance and infrastructure. The infrastructure origination business at BNP Paribas is about 155 infrastructure and PF. It's about 155 people worldwide. We have 5 hubs. As of December 11, there was a portfolio of about 18 billion euros in assets across geographies, and half of that is oil and gas. The other half is power, renewables, and infrastructure. So it's a very important business for us, and obviously that's a business that is undergoing immense changes. I think one key question for us today, which we'll probably debate, is whether we see ourselves as an asset manager or a bank.
Okay. Thank you. Right. We thought we'd try and sort of bring some of the discussions together, but in particular, as we were reflecting on this session, that we'll, for those of us that were here or at one of the other conferences this time last year, there was a good deal of discussion around alternative debt solutions, and many of the solutions that are still mooted today were being talked about then as something that is likely to happen. There's one or two others that have come on the scene, derivations of much the same thing. So let's try and, given that we are hopefully a great deal closer now to a reality of actually something having happened, and I think we'd all like to think that at this time in 12 months' time, we will have seen something happen. But we'd just take a quick look around the room here and say, well, what do we think will have happened if we sit here in 12 months' time? What do we think we'll be reflecting on as the successes or maybe not that we've faced during the last 12 months? Ali?
Well, I hope that a Pebble deal will have happened by then. Sorry, not to be proprietorial about it. No, I mean, I hope that we will have had some deals done. We heard from the EIB just now about the fact that they're under some pressure as well and the money will go away. I mean, looking 12 months ahead, I think something's got to have happened. There are some deals in the pipeline for next year, the A9, the A7, etc., the A11 as well. Hopefully something will have happened, and I'm quite relaxed, actually, to be honest, about which particular product is used, but we need to get on with this now and make it work.
I think the message from us is very similar. We need to get on with it. We've been working at it since the post-monoline era, looking at various different options, working on lots of live deals through the bank bond funding competitions, so far unsuccessfully, but we're seeing a vast amount of interest from not only from sponsors, but also from procuring authorities, wanting to actually investigate the project bond side of things a lot more. And we feel we're getting towards an inflection point in the market where we're almost within reaching distance.
So when you're being asked to investigate the project bond solution, I mean, how are you finding you're competing? I mean, you've got some of the same problems that the EIB face, or challenges, shall we say, that you've got an in-house lending operation that sit there and no doubt compete with you helpfully. Sometimes you can complement each other. How do you find that reconciles? So we've heard a little bit how the challenges that presents for others.
Yeah, we definitely find we are competing against our own internal lending colleagues to a certain extent, and the wider kind of loan market per se. But we don't necessarily see that project bonds are kind of all or nothing, and project bonds itself isn't a one solution item within that. There's many different versions of how they're going to come about, whether it's with EIB's PBC, whether it's with Hadrian's Wall, whether it's Pebble, whether it's any other multiple different solutions that are out there at the moment. That's part of the crucial debate of getting there. But in terms of the loan market and answering your question, we see that bonds can coexist alongside the bank market.
Yeah, on that side, we're actually now trying to
put together a sort of typology of investors, and in fact to look at how to best address the needs of these investors, whether they want to look at a bond product in a sort of project bond format, or whether they want to look at a loan repackaged as a bond, in fact, so kind of a private placement, or a traditional loan product. So for the traditional loan product, I think we've spoken a lot about the funding gap, and I'm ready to challenge whether there is really a funding gap at the end of the day, because in fact, if you look at the largest projects which have come to market, they've all been but oversubscribed. I mean, they have been oversubscribed, and most often by banks. So I just want to introduce maybe a typology of deals and investors. On the deal side, you see typically corporate infrastructure, 5-7 year tenors, where it's privatization of assets, M&A situations, and here banks are literally falling over each other to do these deals because they're relatively short. The pricing is become good on a standalone basis, and there is a bond takeout. And so there's a very clear exit, bond takeout, so you get the bank side and the bond side, the loan side and the bond side of the bank working together. If you look at greenfield infrastructure, renewables and PPPs, long-term tenors, this is where I do see a place for pension funds, notably, because this is where they want to get the tenor, and this is where they will complement the banks. And this is where banks are failing at this stage. so far, there's been two types of deals. The smaller ones where the sponsor is not so visible or is a certain caliber, which means that they have to agree to terms negotiated with new entrants, such as pension funds. And you have the large, well-known multinational sponsors where, if you look at the Middle East, for instance, if you look at those smelter or refineries in the Middle East where capex is $10 or $20 billion, there is never an issue. It's always subscribed, and in fact, it's oversubscribed because banks are falling over each other to do these deals, despite everything. So if you now look at the typology of investors, and this is where my effort is really, is to differentiate between the direct investor, and we've heard a lot from Allianz and LGI and MetLife, and these are, I think, the entrants who are going to change the market in some way. I mean, they have staff teams and they want to directly invest alongside the banks, or sometimes alone, why not? And then you have the sort of managed account situation where behind a well-educated investor, you're going to have a series of less educated investors, giving their trust to that fund manager, and they are people we interact with. But at the end of the day, the fund manager is really the game changer here. And then there's a whole array of thousands of funds who are willing to be invested in an infrastructure asset class, but they have no appetite for loans at all. They have no appetite for structured products. They want structured, I mean by that, repackaged products. They want a project bond with a proper rating. And so where this market will be, I can see two types of situations. One where it's project bonds rated, and this can be distributed widely, and very few situations where the sponsor has needed to invite institutional investors as co-investors alongside the banks.
Can I just add something?
Yeah.
Just to follow on from Alexis' point, I mean, I agree with everything Alexis says, and I think that Alexis made the distinction between investors that want to invest directly and others that will invest via funds. We see certain banks already doing that. For example, Decker's got its own fund in Germany for institutional money, but there's also a third option as well, or a third method, which is the co-partnership sort of arrangement that we've seen between Natixis and Ageas, the Belgian insurer. That could be another option, whereby I think from what we read in the press, it's about $2 billion that they're investing over the next 2 to 3 years outside the Benelux region. And the idea there is they partner up with a bank that has the credit expertise to do a lot of the heavy lifting. They provide some additional firepower to the bank, and they go in on a sort of a joint venture basis into the deal. So it's not a sub-participation. They're not sitting behind a bank because they don't want to take counterparty risk with the bank. So they don't want to be fronted, but they want to come in alongside. But that could be another way of doing things. And just one other point, just in terms of the different strategies we've talked about attracting this money. And I mean, there's another one going on as well, which is the UK Guarantee Scheme. And that is something that's being looked at in relation to the Drax power station right now, which is very, very, very large power station that's been refinanced recently, and it's going to be they're trying to convert this to a biomass facility for environmental reasons. And from what I understand, at the moment there are some conversations going on with the UK government about this guarantee to try and enhance this up to a sort of an A- rating to attract institutional liquidity into this particular deal. So that's, again, one to watch, and another example of a government trying to get this whole thing kick-started.
Well, maybe to add to your second point, what I'm a bit surprised about is, and it's also what's happening, I think, today over here, is we all conclude that it is all about experience also from the institutional parties. And whenever there's experience and there are some deals closed, it becomes much easier, and it's easier to truly evaluate the risk profile of these PPP deals. And we are all talking about the larger deals in the market. And what I think what we should do as well, and I hope that is going to happen in the coming 12, maybe 24 months, is that more and more parties will basically say, well, let's choose for these initial projects what smaller ticket sizes. Let's look at the smaller projects being less than 200 million, for example, and use these projects to basically tune a new risk allocation, because that's what it's all about. And I think contracting authorities have to get used to it. They have to shift a bit by having fixed rate products, and it means something, but it's the same for sponsors. it's the same for the institutional parties themselves. They have to get used to the overall DBFMO setting, and when the stakes are that high, it's very difficult to get in that one perfect model. And I think it would be very wise if the market will use these smaller deals as well. Maybe take some loss that you know for sure that it is a lot of effort for the smaller deals, but then there will be several solutions where we can learn from, which also help to get to produce or construct the models that are necessary for the larger deals as well. And I think that will happen, and it will result that some institutional parties will be directly involved in some smaller deals as well, for sure.
I was going to say, I mean, when you're advising some of the consortia, is there the patience to go with some of the R&D work indeed?
Yes, well, it depends on the number of opportunities you have. So it is so simple like that. And I think that was already said this morning. There won't be 3 consortia bidding, all having a fully banking solution for the long term. And well, if you're in a fortunate position that you don't have the long-term structure with the banking solution, well, you have to be creative. And I think there are many opportunities to come along with new funding structures where you can basically have a competitive package already now, today. But, well, you have to be creative, also in the competitive dialogue with your contracting authority.
Just to add one point on the funding gap that you were talking about, Alexis, that there's there in the bank market for the tenor. I agree the large deals are inherently the ones where you're going to see bond participation because the bank market can't get there on its own. But I mean, I think for the overall development of the market, if some of the smaller deals get done, more potentially on a private placement basis with some of the sophisticated investor base out there who are hiring expertise and building up their teams, that's going to be a crucial step for the market to get towards more kind of publicly syndicated bonds that are done out there to enhance the whole market. And therefore, once some of those smaller deals are done, some of the larger deals, as you were pointing out, which are a lot more risky from a procurement perspective, can get done as a hybrid with both bank and bond as part of them.
Yeah, I mean, just to follow on from that point, I think in terms of the smaller deals as pathfinders, we're seeing this. It's being reported that Alder Hey, for example, in the UK, which is this I think 270-bed hospital, is attracting a sort of a partnership between SMBC and Prudential, M&G. Prudential's taking out the long-term piece. I think it may be post-construction. It's not clear to me if it is. And SMBC is providing the construction part of the facility. So again, that's not such a huge deal. But again, if those kind of things happen, it will create confidence. And just one other point I wanted to mention as well. Alexis made a very, very important point about this difference between acquisition-related deals, which are, for example, gas distribution networks that we've seen, 3 and 5 or 7 year tenors, acquisition deals where multiple parties are tripping over to get these assets, and banks love it. In those kind of deals, we have actually already seen institutional money coming into them, and has been for quite a while. An example is Open Grid Europe, a deal that we underwrote actually earlier in the year in Germany. It was a sale of the gas distribution network in Germany that was acquired by Macquarie, and Prudential came in for a very large ticket on that deal, presumably because it wants to position itself for a decent allocation on the bonds. And I think that will continue to happen. Obviously, the focus of the conference has been much more on greenfield PPP and how we get them into that market. But just bear in mind that this is already happening and has been for some time on the acquisition-related stuff, albeit there is no construction risk here and it's a different kind of asset, but it's already happening.
That's interesting what you're saying, because I can see this market, the corporate infrastructure market, sorry, following the lead of the leverage market. How the leverage markets evolved 4 or 5 years ago, in fact more than that, where institutional investors have become the bulk of the liquidity in that market. Once the asset class has become more commoditized, and once there is a regular flow of deals coming to market, I think the issue we're facing now with corporate infrastructure is that it's still sporadic. It's still linked to M&A situations, and so you don't have that many deals coming out. But for those which are coming out, they're investment grades, they're getting a standalone rating. There is bond and loans, so you have the format, you have the alternative between the two formats. So I'm hoping that as we see more of these deals, there'll be more of a benchmark and more institutional participation in these deals. They'll become a more stable liquidity pool. Clearly for the greenfield long-term projects, I mean, there's got to be more tailored solutions, and there's obviously a less constant flow of these deals in the market.
Yeah, I totally agree and emphasize that from the DCM side of things. Investors are definitely comfortable with those kind of what we call economic infrastructure or non-greenfield type deals. That's got a proven track record. Having that expertise, even for some of those more structured transactions, helps set benchmarks and helps get those along. If we didn't do those kind of deals, our senior management wouldn't allow us to sit around and do R&D for project bonds. We wouldn't be around doing it anymore.
On that right note, maybe I could ask, are there any particular observations from anyone out in the audience at this point, just on this point, in terms of some of the, people that are remarkably quiet that aren't normally so, but anyway.
They're exhausted.
Exhausted. Okay. It's interesting. I think one of the observations I have is that, there are, I've watched this in the loan market, I've watched it in other areas of the bond markets, as you start to get when things are more esoteric and more bespoke, inevitably you've got a smaller universe of risk takers, be it banks, be it institutional investors and so forth, because you've got people that are sophisticated and can manage that risk through its life, whatever type of risk you're looking at. The moment you start to get into larger transactions, the challenge is actually putting it on a plate so you can get the wider range of investors. And I think the same would apply when it comes to the very large deals that have gone into the bank market successfully. I'm interested in, what are the differences, and so putting you on the spot a bit, that you've seen in the bank market and the bank syndicated loan market between the smaller bespoke transactions where maybe it's been done in a small consortia deal to the larger, fully syndicated deals that are liquid in the secondary loan market. Have you seen significant differences in order to attract that additional liquidity?
I would say, the irony is the bigger the project, in fact, very often the more oversubscribed it is, and it's. You tend to see the same in the least, but because they're big and they're backed by very powerful corporate sponsors with a huge range of ancillary business to provide. And we see situations of, gas networks being privatized and other similar situations where you have up to 5 different trees and each tree is fully underwritten.
You do. Yeah, I mean, just to add to Alexis' point, because Alexis, he's just come back from Bahrain recently, right? And he just touched on the Middle East. I mean, the Middle East is hot right now. I mean, actually, that's a bit of a sweeping statement. It depends. It depends where. Yeah, it's warmer than here. Yeah, that's a good point. It depends where in the Middle East. But I mean, if you look at, for example, deals like the Sadara Petchem project, it was a 20 billion project by, I think it's Dow Chemical and Saudi Aramco. I mean, these guys are gorillas, basically, right? I mean, these guys are going to get this deal done probably at pricing in line with what happened on Barzan last year, which was done by Qatar Petroleum and Exxon. I mean, these are huge financings. They attract ECA money, they attract Sukuk, they attract project bond, they attract a whole range of stuff and a lot of local liquidity. It's already happening there with a lot less so with fewer issues, I think. Now, maybe that's because there have just been a few more of them and people are just hungry for this type of stuff. And we're also seeing these project bonds happening in the offshore space. I mean, I don't cover offshore, but basically I spoke to a colleague earlier in the morning and I was saying to him, look, we've seen project bonds in your space. And he said, yes, I mean, typically what happens is that the banks will fund a large part of the construction period, but then just before the construction period ends, 12 months before, they put it out into the bond market. And this is happening quite a lot. It's happened on, I think there's one 500 million deal happening, about to launch very shortly, and there's been another one earlier in the year. So it's already happening on that side. And that just sets a precedent. I can't see why it can't happen in our market too.
I think just to add one point to that, one of the key hurdles that we see with going from the kind of bank to bond model often is the hedging and the interest rate swaps that are put in place. Because if they're put in place for the construction period of 5-7 years, fine. But if they're put in place for 25, 30 years, often what we found is the mark-to-market and the breakage costs are just insurmountable for most sponsors to accept as a hit for their P&L. we've looked at various different projects over the years in terms of looking at refinancings, and I think especially in the PPP sector, that's why we've seen very, very few refinancings.
So I'm interested in this, the concept that big is very beautiful in that sense, and that the bigger we aim and the more ambition we have, let's focus on Europe and learning from what we've seen elsewhere, potentially this becomes a rolling ball coming down a hill, and it's going to attract an awful lot of other interest. Is the panacea therefore just to come up with a big project and make it happen, or is it to actually? This is where
I think what we should have. I mean, what Jeroen, the point we made is that smaller deals are, I think, perfectly fit the bill to test new solutions, because they're more specialized. They don't attract the same kind of diversified liquidity as the mega deals, which in the case of Cedar you mentioned, it's a 20 billion project. You only have $1.5 billion from commercial banks. They don't need more, and the rest is provided by ECAs. U.S. Exim brings $5 billion, and it's funded by U.S. government. And so that's size also means that there is access to all these diversified funding sources. So for smaller projects, I think, which is probably what's more interesting here, because they're more difficult. I think there is the potential to be more. I would say I hope that there is potential for sponsors to be more creative and the sort of risk that they are happy to take. I mean, there's a leap of faith at some point in time.
Yeah. I mean, I agree with you. I agree with Alexis, and I think that we've seen some very experienced investors here at this conference, which has been very, very important. And I honestly think that we have to look to work with them, the more experienced investors that have put up the money and the investment to build up their teams, like Allianz, Aviva, LNG, etc. They're in the process of building these teams out. I think we have to look to them to start the ball rolling, working with us collectively to make this happen, because they're the experienced ones. And I think that once a couple of them are done, then it will start building up.
Maybe I can add a bit to it. I just went through such a process, and basically what you see is we all say there's not enough experience, and as the interest in the smaller deals are a bit smaller, it also makes that you can actually start with a blank paper. And you come into a situation that you basically sit together with your institutional investor and can truly have a discussion on what are your interests. And you know for sure if there is, for example, banking experience on board, that there is somehow a way where you can basically contribute all to the deal and come into a situation that you find a solution which beforehand you did not think of, that this is what it should be. If you're talking about flexibility that is necessary in the construction period, pricing certainty, how do you do it with termination, and how does your contracting authority respond to it? All different kind of topics, which in a bigger project, it's very difficult to come in a situation that you can truly discuss with it. And in a smaller project, it's also easier, and especially in the Netherlands where you have a good dialogue process with your contracting authority, you can basically explore that for a year and come up with a solution which works. And every project will have a slightly different solution, but it doesn't matter, as long as you get deals closed and in the end can scale it up.
I hear you. And one of the questions I have, rhetorical questions here, is when you take lessons learned from the bank loan market, and as we've gone into bigger deals, we see clearly a whole range of lenders coming in that are not necessarily or don't necessarily have specialized teams in the project finance business and in the infrastructure sector. So are there lessons we can learn in terms of trying to attract beyond the 4 or 5 and another 4 or 5, no doubt, that are not here tonight or this afternoon? How do we attract the rest in? What are the lessons we can learn from the bank loan market in terms of saying we want to, if we're going to embrace, let's say, a 500 million euro big plus deal and take it outside of the lending market and into the capital markets, how are we going to create that platform? What would you love to see in your stocking at Christmas?
Well, when you said lessons learned, what I don't want to see is subprime. I don't want to see that happen. So we've got to be a bit careful. I mean, I think it comes back to the different approaches, like the approach that, for example, Deca is taking as an asset manager, the approach that Natixis is taking. So there are multiple approaches. The people out there, the institutional investors that haven't got the big teams, or not prepared to do that right now will find other ways of getting into this market by forming partnership arrangements or using asset managers. So I don't think we should get too hung up on there just being one way that they can. I mean, they'll work out multiple ways with banks. But I think the first mover advantage will come with the bigger players.
I fully agree with you, Ali, and it goes back to my catchphrase, at the beginning, are we a bank or are we an asset manager? I think part of the response is that we are going to be more of an asset manager in the future than we cannot only be just a bank. Yeah. The bank market alone will not respond to the bank. The bank's balance sheet will not be sufficient to support the needs of the market and the requirements of the investors. So we know of the few investors who have staffed their teams to go direct, but the bulk of the interest out there is from investors who have little time to allocate on each and every deal and want a fund manager. So I think we will see more banks being active in the asset management business, potentially reallocating their very large teams to the asset management side and acting as a co-investor and partner to these investors.
Yeah, I mean, just on that point, to follow on Alexis' point, there's this PIP program, Pension Infrastructure Platform or something in the UK, which the UK government's very keen on. So Osborne's been talking about attracting $2 billion into this whole thing. They've got about 7 pension funds in there, including the Strathclyde pension fund that was there right at the beginning. Good for the Strathclyde pension fund, I say. So we'll see how it goes. So looking 12 months' time, hopefully that fund will be in place. There's a lot of political pressure for it to happen. A lot of people getting rather twitchy in Whitehall in the UK at the moment. This has to move.
There's one thing which I think is interesting, and I don't know whether there's an answer for, but what is difficult in that situation is that we are coming from a traditional banking market and the banks are transforming into a new role and long-term money is coming from different parties. It's not automatically that the interests are aligned, as at least the institutional parties do not basically experience, or they are a bit skeptic about whether banks can have that role. So I think what is necessary is that you have that open discussion, and maybe it's not possible through banks being directly involved in the same deal. So it's also about how did you get that objective education which is necessary for the institutional parties. How do you get that in place in the struggle to find a new solution?
Thinking about one or two of the topics that come up recurrently. I mean, one of them is the interface with the procurement model and the ability of almost any of the bond solutions to interface with the necessity of giving advance commitments to meet some of the procurement requirements at BAFO stage and indeed beyond that. Thoughts on solutions there? Do you think there's enough give on the procuring authorities side in order to stimulate this? I mean, they talk the story clearly. Do you believe are you seeing enough movement? Okay.
Yeah, I see some movement, to be honest. What is always difficult is to change rules during a tendering procedure. So there are some limitations. But I think what you should do as a consortium is trying to find solutions which fit, at least for 99%, fit within the current tender procedures. And I think there are a lot of opportunities. And there are some aspects that should truly be changed, but it is also a question whether the documents should be changed or that there is already within the documents that are there in the regulation that there. I think there are a lot of opportunities to get different funding solutions also to make them compliant within the current procedure. And what I see on the government side that there is a lot of willingness to explore this, but it gets scary when you need to adjust the rules. Because, that makes it difficult in the comparison during the tender procedure. So I think within the procedures, there's at least a lot of willingness, but their hands are a bit tied. On the other hand, what I see, and that's something that should, in my opinion, improve, is as long as there is traditional bank debt, there's not a lot of necessity to move. But that's, a short-term vision. So I think it would be much better, to also already, you can point out in a couple of years we will have a different risk allocation at some deals. And for now you could say, if it's not necessary, let's do not do it. But on the other hand, you also not moving ahead to the situation where we will be in maybe 2-3 years. So
I
I think
agree.
the government could be a bit more active in thinking about what will be the new tender procedure, and are there any things to be changed which are really necessary to scale it up, for example.
I agree with you. I think until we get to that point where the bank market isn't quite there so much, authorities are going to draft new rules that are very much based on the old ones, and there's still going to be a challenge for the bond market. Not that we would ever want a procuring authority to have a deal fail on them, but we might actually only get to that point when a big serious public deal does actually get to this point and doesn't achieve, and it makes a whole-scale change within the public sector. I think at the moment the public authorities are still sticking, because they've got enough access, just enough access to bank funding, maybe not quite the tenors they want. They're sticking relatively close to the old rules, as we were talking about in previous sessions. Wanting that flexibility for refinancing, for not having spends, wanting certain funds. It does make it challenging for the bond market, but on the flip side, we recognise we have to work within the rule set, and no special situation should be granted for the bond market.
I have one example in mind, very, very quickly, on the point of authorities agreeing to change the typical bidding model. It is Abu Dhabi, which is known for having had a very, very successful IPP model over the years, and 6 or 7 IPPs, I think, already financed on a very long-term debt basis. And the next one coming up, which is called MERFA IPP, IWPP, is offering bidders to come up with 2 alternatives. One is a 23-year debt, typical long-term amortizing debt scheme, or the other is to come with a 7-year minimum. And bids can be compared like for like, and each bidder is asked to come up with the 2 alternatives. So that is the very first time we see this in the Middle East, in fact, from a procuring authority on a procurer at WEA which has a spotless track record of raising the funds on a long-term basis, but they can see the wind of change. So
I think it is getting there, as we were also talking about in the last session. The A11 project, the procuring authority has been making some moves there, and across Europe it is starting to get there. But I think some of the deals are still under old rule set, and we desperately need precedents to actually succeed in the market to open up.
I like the observations relative to the high yield and leveraged loan market. And as you say, the way that grew up, you saw institutional investors playing in the loan market and leveraged loans, just as we're starting to see in the infrastructure world now, clearly with M&G, Allianz, and others. And then we saw the high yield market eventually coming over from the US. Clearly that has grown out of all proportion now, and I think, in many cases, a bank like yourselves are going to be bidding, may not be both solutions, but you'll choose which one you think is best for that solution or for that problem.
Yeah, just on your point, Ian, about your question rather about the procurement authorities and how this all works, there has been some talk at the conference about how the procurement authorities deal with institutional investors coming in after BAFO submission date, which it'll be interesting to see what they say on this. I'm struggling to see myself how they would deal with that. I can understand why investors would want that, of course, because they have limited resources and they can't focus on multiple bidding consortia, and that's perfectly understandable. But from the procurement authorities' perspective, I guess they would want to know that the bid that they're getting is they're good for the money. So that'll be interesting. Maybe, and I don't think this will happen in 12 months, but maybe over a longer period, what we'll eventually get to is perhaps something that happens in Canada. We heard from our friends from Macmillan and Scotia. Essentially what they have there is that the banks basically get the deal done, they underwrite the deal, and then as soon as you have your preferred bidder, you basically sign the docs very quickly, get the whole thing finished, and you put it out you put it out with the institutional investors. So they take the construction risk and everything else. But you have sensibly, everyone knows the game. You have sensibly structured projects that everyone understands. And you have decent equity checks in there. And in some cases, people are talking about credit enhancement, different types of credit. Pebble is another example. Well, if equity investors are willing to put in more equity, you might not need credit enhancement if you can get to your A minus equivalent rating anyway, because more equity is injected. Now, there's a cost for doing that, but the benefit is that you get your long-term financing upfront from your institutional investors, and you know it's there day one. So yes, you pay on one side, but you have certainty on the other of long-term financing.
So
I think part of it comes back to, as you were saying, the sponsors, not just the equity, but the construction support and then the operational support going on. I know some of the sponsors are used to what they accept in the European market, and the same sponsors maybe put a bit more into Canadian market because they know that's what they need to get there into Canadian market. And that would help get projects up, so you wouldn't need credit enhancement from other sources if that was available in the European market.
Yeah, but the big difference between us and the Canadian market is that the Canadian banks have always been very firm. This is in the US as well. They don't do beyond 10 years. I mean, 10 years is already too long. Until we get there, and maybe Basel III will have its impact at some point on banks universally, and maybe that will take 12 months, maybe it will take longer. But when we get to that point, I think this will all become a lot more stark. It will have to then happen. There won't be any choice.
So when we think of construction risk, I mean, we've heard through this conference the theme that construction risk is not the barrier and not an impediment, even though it was it's been talked up by many, certainly in the media, as the barrier. What do you see? I mean, if you look at that and say, well, okay, for an institutional investor, and more importantly for the sponsors, managing that interface with the lending community or the investors through the life of a transaction. It's one thing dealing with one institutional investor that's sophisticated, that's got a team, another thing dealing with a group. Yeah. How do you see that panning out?
Well, if you start with the individual investor, I think it's all about, at the moment, it's just you should see how the PPP contract works, because a lot of institutional investors have a different view, because they come from private placement market where the setting is totally different and the security package is totally different. So first thing you need to do is basically guide them through all the different lines of defense that are in the contractual structure for PPP projects. And then basically I fully understand institutional investors today saying, well, in the end, it's not a no with respect to construction risk, for example, because if they basically are fully exploring the risk profile, they get more used to it, and I think there is place for them to truly value it. Yeah, so, that's for the smaller deals, and for the big ones, well, maybe you can explore a bit more.
No, we're just going to make the point about the controlling creditor question I asked in the last session, because I think it was mentioned by some of, at least maybe one of the investors over the last couple of days, that look, we don't really want to get bothered with constant waivers during the construction phase. Even if we're happy to take construction risk, we don't want to be called every 5 minutes with some waiver issue. And that may vary depending on the appetite of the institutional investor concerned to get sort of involved in this level of detail. But that was my question, because, I mean, the Hadrian's Wall, I think, effort and the Pebble effort kind of addressed that issue, because the heavy lifting on that side is done by the subordinated debt provider. Whereas I think on the EIB side, they're also taking a different view. I mean, maybe that's the case, that they believe that institutional investors will want to do that. That remains to be seen. So I think, again, on that, the jury's out, I guess, and investors will vote with their feet as to whether they want to go down that road where they get more protection and they've got a bank dealing with the nitty-gritty, ongoing, mundane stuff, which is important, but, mundane. They don't want to get involved in that. They've got their credit enhancement, they've got long-term thing.
It is a bit of a grey area.
It is a grey area.
And well,
we haven't worked it out yet. No. We have to wait and see what the preference is.
Yeah, I agree.
Of course I'm going to make a comment.
Come on.
No, I was just going to say, I think that we have to be careful also to differentiate between institutional investors taking effectively private placements versus public bonds. Public bonds, getting the creditors together with everything out in the open, that's difficult, but you shouldn't assume that institutional investors are only interested in public bonds, and therefore I think it will be extremely manageable, because it doesn't take a lot of institutions in order to drive decision-making on a private market basis.
Stephen, I know you've been polling a lot of investors over the last year or two.
Yeah, we have, and I agree with Deborah. I think the first couple of deals that get done will be done as more kind of private placements, as we get towards, larger deals that maybe can be done in the public market, this is a crucial element that does need solving, and that, as you said, there are lots of different options available out there.
Seb, I mean, you're similarly hedger as well.
I think the idea of having 90% leverage in a public bond with nobody doing the day-to-day credit management is not going to work, quite frankly. I mean, you could theoretically imagine a scenario where there's fewer covenants, but then you need a lot more equity. That's probably more expensive. So I think we're all trying to bridge the gap by providing something that takes both of those boxes at a lower cost.
Okay. I mean, obviously, from our side, we're already providing that service, and it's something that we're set to roll out, for new transactions and have a team that's ready to go in terms of that service. And so I do think it's challenging. Is all I can tell you. And working on specific opportunities at the moment, the complexity, to Deb's point, of getting some of the decision-making processes to work in a public bond arena, are not they're not without their challenges. Is the best way of putting it, because of the whole issue of public disclosure on public bonds. I'll come. We're sort of running towards the end. Can I ask anyone have any questions that they'd like to pose, either within the group or on a broader basis? Yes.
Just a question on the investors, on the institutional investor side. Do they have any specifications on their investment guidelines? Like they are not allowed to invest in straightforward debt or an unread debt or whatever. Or they do they have, so it's in any country different, so I can't only judge for Germany, so I can't say for Holland or for Belgium or France. So are there any specifications on the investor side, which is...
Well, that's, to respond simply, if I may, I mean, it's every investor is different, very much so. I mean, it's if you look at the French market, which is probably one of the most restricted markets in terms of the ability that insurers, in particular, have to play in, in a loan format, for instance, for a typical French insurer, it is just not possible, unless it is perfectly guaranteed by an OECD member. And I can see Deborah. It is very, very difficult unless you find a pocket to put it and equity in front of it. But I think
the problem of regulation that goes in the 10% has to
exactly. So, yeah, right. So there is the appropriate amount of equity in front of the. So I think generally, you see, every investor will have a different take to it. Whether you want to, be the traditional insurer and probably go behind an asset manager and only buy a rated product in a format that you like, or you want to be more proactive, as Allianz is doing, and you go direct, and there is more equity involved.
I totally agree with Alexis. Just to kind of emphasize that, all our conversations with investors, we do find investors are different. We have exactly the same experience with some of the French insurance companies. Whether it's an OECD investment can be a major issue for them. From investors from Germany to Italy to the UK, they are all different, have different needs, and that's why it is a difficult process to go through. But it is manageable, and I think as we have more and more sophisticated investors who are putting the resources into their teams, some of them who are willing to do that credit management and potentially do that control and creditor type work themselves, acknowledging that not all can. I think it is a surmountable challenge.
I mean, it's interesting. I mean, one observation that to endorse that view, I can remember a conversation with the CIO of one of the largest pension funds in the world a year ago or so, and he was adamant that they do not invest in infrastructure debt, never have, never will, much way outside their guidelines. On their website, they do disclose their entire invested portfolio, and sitting up there as one of their top debt exposures was one of the largest UK PFI deals, a wrap transaction sitting in the sterling secured index. It's interesting. That's all managed through an investment manager in London. Now, his view was, I'm sure, as I said to him, well, how does this fit? He said, oh, that's sterling secured index exposure. He didn't think of it as infrastructure. So I think the lesson of that is, how do you package something?
Yeah, absolutely.
And how do you package it to attract the investors? Yes, there are those in this room that will will adapt their offering so that they can come and meet the opportunity in the loan market and so forth, and package private placements in that way. But for the majority of institutional investors, it needs to be packaged in a way that they can buy it within their existing mandates.
I think two of the key elements for the wider investor community that don't have those teams to get to those levels that you're talking about usually is twofold that we find as the key headline things every time we talk to investors is, one is the index classification that you touched on, and two is the size of the actual bonds. They want them to be of benchmark size and to be liquid enough. Most of these more wide-scale investors have mandates which have to be quite often investment grade, so they have to have an exit opportunity. So therefore, they want the ability to sell out in the secondary market if there's a deterioration in the credit. So often we find in the UK, for benchmark size, we're talking 250 million to get into the iBox index, 250 to 300 being typical benchmark size. In Europe, that's more like 500. Which is a challenge for some of the greenfield projects that we're looking at. It is those medium-sized projects which are going to be more difficult to deliver those kind of public bonds at the beginning. As you rightly point out, the large deals are going to attract a lot of people. The smaller deals are going to either be a combination of private placements into the bond market, institutional money, or the bank market. It's those medium-sized deals which are going to be more of the challenge.
Yeah, I agree. I mean, as a roundup, we've got 5 minutes to go, but the quick answer, therefore, I mean, if you're looking forward, therefore, go back to the 12 months' time and think, okay, will we have seen a public bond solution preferred and actually gone to the market for in Europe for an infrastructure project? And if you want to be have a view, I can sort of guess where Ali's going to come from in terms of which one will it be.
It's probably a question for Stephen, but I do think that there are several mandates out there for infrastructure corporates or projects which are just about to print.
Absolutely. I mean, we're working on quite a few mandates at the moment. We would have hoped that we might have had one already by this time in this year, but certain things have conspired against us. I wouldn't like to, I'm not going to speculate exactly on which sector, but I do think within 12 months there will have been a project bond done, whether it's within some form of credit enhancement structure like EIB's PBCE or Mowll or Pebble, or whether it's without those kind of credit enhancements remains to be seen. I do suspect that it will be done more on a private placement basis with a smaller group of sophisticated investors before, in the future, we get out to a more wider syndicated market.
Yeah, I mean, I agree. I totally agree. What I will be doing over the next 12 months is updating my CV, though. Just in case we need to migrate to the new paradigm shift occurs.
I have nothing to add
to
this.
I'm well, as you can guess, I'm equally confident we will see a solution. I think it'll come from one of the solutions that's established. I love to think that Pebble will get over the line. I'm very confident the project bond will get over the line from the EU, and I think I do think, though, and we'll see more from the likes of a Bank solution as well. And I'm quite sure we're going to see probably, it'll be interesting to see how much we see shouted about in terms of publicised from some of the private placement solutions coming into the market. Because, that I hope we get some publicity from those, because I think it's from that we'll be able to learn some of the structural solutions that need to be adapted to make some of the more liquid paper come into the market that is not necessarily in the credit enhancement world. And that will give the market confidence in itself. Any other observations? Anyone wants to chip in with the last comments? Or not, I'm going to ask you all to thank the panel in the usual way. We're about 2 minutes early. Thank you.
Thank you.